Welcome to today's webinar, The 5 Factors of Innovation Success, an Advanced Plastic Recycling Use Case. My name is Zhenshen Yu, Senior Director here at Lux Research, and I will be moderating today's session. Presenting today is my colleague, Martian Lee, analyst here at Lux. Throughout the webinar, you can type any questions you have in the questions box on your screen, and time permitting, we will answer all the questions that we can. If your questions does not get answered, please do not hesitate to email it to questions@luxresearchinc.com and we will get back to you shortly. If at any point you experience technical difficulties, such as a frozen screen, simply refresh your browser and check that your interconnection is strong. Now let's jump into the presentation. Over to you, Martian.
Thanks, Yu. Good morning. My name is Martian, and today we're going to talk about what makes successful innovation. I'd like to start with a story that may be familiar to some of you in the audience. A sales executive walked into what he thought was one of the best sales meetings he had ever had. He had the kind of customers that he liked to work with in the room. They were incredibly engaged and started to connect what our friend was offering to some of the challenges that they were facing. And the discussion was landing until they got to pricing. And the energy in the room changed almost instantly. The conversation started to shift from value creation to focus on the dollars spent. And as many of you would have already expected, after the meeting, these prospective customers never went ahead with the purchase. And I find this story very relatable because this is a situation that all of us in the room might have experienced before, whether it's in a professional setting, like when we're trying to secure funding for our projects, or even in our personal time, like when we're thinking about buying the very expensive car. And it is situations like this that just adds truth behind the saying. Everyone loves to pitch until the invoice appears. But if we dig a little deeper, I don't think price is always the real issue. The real challenge is actually in justifying and defending the return on investment. So let's say we've gone through this big exercise to identify opportunities that we should engage in. We've deployed our AI tools in Rockstar applications, and now we have a great product or a great technology that is ready to go into scale up and production. The literal million-dollar question is not how much is it going to cost us, but is it going to be worth the cost? Now, in some cases, when we need to make this assessment, we have tools for that. Take financial investments, for example. There are very well-established methods and frameworks to guide investment decisions. At the very least, investors can also look at historical data to make predictions about future performance. With more sophisticated models, we can even start looking at other indicators like discounted cash flows and perform sensitivity analysis to evaluate risk and return. However, trying to apply the same approaches to emerging technology investments is not as straightforward. There is often limited precedent, there is a lot of hype, and there are many what-ifs that have to fall in place for us to materialize any gains that we are projecting. And this is the case even when we have validated techno-economic data, because the data does not tell the full story. These numbers just represent a snapshot in time, and we're making a huge assumption that they will remain the same across the entire lifetime of the plant. Now, we know that is obviously not the case. In the example I show here of Prime's flagship pyrolysis plant, besides the technical challenges to scale up, Prime faced project cost overruns, fluctuating pyrolysis oil prices, and increasing energy costs that all contributed to variability in the company's financial performance. And it is variability like this that manifests as risk, the risk that the project will miss its expected return on investment. In other words, the size of the price at the end of the road may not be as big as what investors had initially expected. And so, we must learn to better account for uncertainty when building the investment case for emerging technologies. And how do we do that? And this is what I'll be addressing for the remainder of my presentation today. We'll start with Lux's 5 factors of innovation success and how do we apply them. These 5 factors capture the most significant sources of variability or risk when projecting returns for first-of-a-kind investments. Then we'll move into scenario building. How can we build in some level of foresight into our assessments? And finally, I'll share about taking action. So let's begin by building our investment case for a first-of-a-kind project. And today, I'll use a pyrolysis project as an example. For our analysis, we need to calculate these two key metrics. internal rate of return, or IRR, and its standard deviation, which represents risk. And just so that we're all using the same language, IRR is a measure of the financial attractiveness of the investment. It tells us how big is the payoff if the investment performs as expected. Now, to actually calculate IRR, we need to know a few numbers, like the initial investment, which is our project capex, and cash flow, which is essentially our revenue less OPEX. And if we have specific plant data to work with, that's great. But if we don't, the good news is that we have access to real advanced plastic recycling plant data that we can refer to today. Now, not all of it is public and not all of it is complete, but I think there is enough to form a reasonably solid benchmark. So, drawing on this public knowledge for our first-of-a-kind pyrolysis plant, we now have got plant capacity, capex, and OPEX from the available data. And then we have the product price, which is the price for pyrolysis oil. For this model, I packed it to the approximate 10-year average spot price on naphtha, its direct substitute. So we now have some basic techno-economic parameters for calculating the IRR of our plant. Then we move on to risk. Risk answers a different question. It asks, how confident are we that these expected returns will actually happen? And if we miss the mark, how far away are we going to land? It is about the uncertainty behind the numbers. And there are two main sources of risk that we want to account for. The first is the inherent uncertainty in plant economics. Even for mature technology, unexpected costs or even savings can always pop up. It's good if we have done a detailed engineering design work to get a reasonable estimate on variability, but otherwise we can always start with some existing rule of thumb estimates, like what we did here to form the base uncertainty for our model. The second uncertainty, and the big focus of this presentation today, comes from innovation maturity. How ready is the entire ecosystem for supporting our technology as a business? And that's what we want to capture through the Lux 5 factors of innovation success. Now, if we were to break down these 5 factors down to their core, they're essentially a set of questions that many investors already intuitively ask. For example, we want to know whether our product is something that the end markets are already familiar with. That's product readiness. Or sometimes we use technology readiness levels, or TRLs, as a filter for evaluating potential projects to invest in. That's technology readiness. But for us, we take it one step further. For each of these factors, we assign a level of maturity ranging from high to low. Then, depending on the scoring, we make an adjustment to the base uncertainty that we had already assigned to CapEx, OPEX, and product price in the earlier step. The adjustment ranges from no change in uncertainty for a high maturity score to an up to 20% or 40% increase in uncertainty for a low maturity score. So, for example, if we are producing a standard grade polypropylene, which is already a commodity material, we do not add additional uncertainty for product readiness because we are already at a high maturity level. However, if you're producing a chitosan-based biopolymer, for example, then it will be a lower maturity score for product readiness, and we will need to increase product price uncertainty accordingly. And just so that we are all clear, these are going to be percentage changes to the base uncertainty when we are not directly adding the increases to the parameter. So with that, let's dive into what innovation maturity looks like for plastic pyrolysis. And we start with product readiness. We want to measure how familiar the value chain is with pyrolysis oil. Pyrolysis oil as a product is already relatively well understood. We know its properties, and we understand how it can be used in existing refinery and petrochemical processes. However, the challenge lies in consistency. In practice, pyrolysis oil that is suitable for one refiner may require additional post-processing before it can be used by another. So, from a maturity standpoint, we will classify product readiness as medium, and this translates into a slight increase in uncertainty for product price. Next, we look at technology readiness. Has pyrolysis proven itself in operational environments? Now, this is sometimes debated because we have seen both successes and failures at scale. But overall, given that there are operators such as ExxonMobil that have demonstrated successful ramp-up and operation, we can reasonably consider pyrolysis to be at a high level of technological maturity. And so we do not add any additional maturity here. We do not add any additional uncertainty here. Then, moving on to market organization, we're looking at the supporting regulatory frameworks and the status of the supply chains. With regards to regulations, they're close to being formalized in some regions like the EU, but they're not yet fully formed. In terms of the supply chain, we're starting to see some alignment between pyrolysis operators, feedstock suppliers, and pyrolysis off-takers, but much of it is still in the early stages. So, being a bit more conservative here, I would rate market organization as low maturity. And because of this, we assign 20% greater uncertainty in OPEX. Moving on, we look at market readiness. We want to know if there is going to be an attractive addressable market size for pyrolysis oil. Here, pyrolysis oil has the potential to serve a very large market that is essentially as large as naphtha, which is worth hundreds of billions of dollars a year. However, the current demand for pyrolysis oil is still largely driven by the expectation that the downstream markets will increasingly demand pyrolysis oil to fulfill their recycled content obligations. However, this is a big bet that we don't know for sure yet. So, I would classify market readiness as medium. And as a result, we increase the uncertainty in pyrolysis oil prices by about 10%. And finally, we consider production readiness. We want to know if we are able to physically construct a plastic pyrolysis facility and produce pyrolysis oil. Now, this is actually one of the stronger areas for plastic pyrolysis. We already have approximately 850,000 tons per year of pyrolysis capacity installed worldwide. And it proves that we have the capacity and the capability to design, build, and operate these plants. So, from an engineering and construction perspective, this is relatively mature, and we do not add additional uncertainty to this dimension. So now when we bring all of this together, we now have our key inputs for CapEx, OpEx, and product price, along with uncertainty margins for each of these parameters. This gives us the data that we need to run Monte Carlo simulations to model the distributional outcomes, rather than relying on a single point estimate. We essentially took a random sample within the uncertainty margins for each input parameter, calculated the resulting IRR, and repeated this process a couple of thousand times to obtain an average IRR and its standard deviation. And based on this analysis, the conclusion is quite clear. Under current assumptions, the investment case for our first-of-a-kind plastic pyrolysis plant is weak, with a negative expected IRR. So now within our teams, we can confidently say that if we were to invest in our plant here, we're not going to make any money. But this is not the end of the story. If I had stopped here, I'm sure you have questions about the green premiums for pyrolysis oil, or what if regulations go one way or another. And indeed, we're expecting some big changes to the status quo in the next 3 to 5 years. And that's why we need to do scenario building, where we model the longer term outlooks, and it is the next step towards building our investment case. So for today, we'll model 3 scenarios, which address some of the weaknesses that we've identified in the innovation maturity for plastic pyrolysis. In the first scenario, feedstock supply infrastructure developments improve on the supply chains, which addresses the immature market organization. Then in scenarios 2 and 3, we address uncertainties in product readiness, market readiness, to some extent market organization, through the enforcement of recycled content mandates and mass balancing rules. And don't worry if some of these developments are unfamiliar to you. I'll walk you through what each scenario means. And we'll start with the first scenario, where we consider developments in feedstock supply infrastructure. Feedstock availability has been one of the central challenges in scaling plastic pyrolysis. While the technology is designed to process abundant, low-value, so-called unrecyclable plastics, the reality is that the aggregated supply of these materials is still limited in the near term. Because of this, feedstock costs today can be relatively high. However, over time, we expect collection systems to become more efficient, sorting technologies will advance, and waste suppliers themselves will also become more familiar with what pyrolysis operators actually need in their feedstock. ultimately reducing feedstock costs in the long run. And so in this scenario, we model that the feedstock cost will reduce by 25%. And this is reflected in the OPEX value. We also assume that a slight decrease in OPEX uncertainty because feedstock supply becomes more stable and more predictable. Now, intuitively, this sounds like it should improve our IRR projections. But when we actually run the model, we saw that there is actually very little change to IRR, despite an improvement to day-to-day profitability. And the reason for this is quite simple. CapEx dominates the economics of our project, so even a meaningful decrease in feedstock cost is insignificant against the sheer size of our initial investment. And now we look at the second scenario, where we look at the impact of recycled content mandates. An example of this is the EU's packaging and packaging waste regulation, which stipulates that packaging materials must contain up to 65% recycled content by 2040. So because of mandates like this, producers are required to incorporate recycled content into their packaging materials. This in turn increases the demand for recycled plastic and also effectively increases the price demanded for pyrolysis oil. The demand for pyrolysis oil also becomes less price sensitive because the mandates create a price floor in the market. So we can also expect a reduction in product price uncertainty. Additionally, the implied regulatory acceptance of pyrolysis oil for meeting the mandates will give greater regulatory clarity and reduces the OPEX uncertainty because of a more mature market organization. So with that in mind, we assume that pyrolysis oil in this scenario can be sold for up to 3 times the price of virgin naphtha. And that comes up to around $1,700 per ton. Now, this may sound aggressive, but the projected price is actually well within the estimates that have been discussed in industry conversations. So it actually reflects buying behavior that is already emerging in the market. So when we make the adjustments to the parameters accordingly in our model, we saw that the expected IRR increases to around 17%. And this double-digit return is when the investment case starts to become slightly more attractive. But you'll also notice that there is a trade-off. While the higher product prices improved returns, they also increase the project's exposure to pyrolysis oil price volatility. So what we see here is a shift. The investment case becomes more compelling from a reward standpoint, but there is also a chance that our investment will underperform by a greater margin. And finally, in our last scenario, we'll discuss mass balancing rules. Refiners typically mix pyrolysis oil with virgin naphtha for steam cracking, and it produces a mixture of outputs, including fuels like olefins and other chemicals. Because we cannot physically trace the flow of the recycled hydrocarbons in the pyrolysis oil to the specific cracker outputs, we need to use an accounting method to allocate the recycled content, and that's mass balancing. In our earlier assumptions, we applied free allocation mass balancing. In practice, this means 1 unit of pyrolysis oil directly translates into 1 unit of recycled plastic. However, this assumption is increasingly being challenged. In some regions, such as the EU, we are seeing a shift towards stricter fuel-exempt mass balancing rules. In these rules, fuel-exempt mass balancing penalizes fuel production by placing tighter constraints on how recycled content can be allocated. So for our scenario, we'll model a more conservative case by assuming that only about 50% of the pyrolysis oil can actually count as recycled content. So what this means is that it now takes 2 units to produce 1 unit of recycled plastic, and we will see a proportionate reduction in the premiums that we can ask for in pyrolysis oil. As a result, our pyrolysis oil price is now adjusted to be about $1,200 per ton. So plugging in these numbers into our model, we saw that fuel-exempt mass balancing essentially killed the investment case by almost halving the expected IRR of the mandate scenario. So while the project may still generate positive returns, the size of the returns may no longer be sufficient to justify the amount of capital investment. And we're already seeing this projected impact of strict mass balancing rules on the investment case play out in real life, where several major plastic pyrolysis operators have already shut down plants Or are we considering expansion plans in regions with stricter regulatory frameworks? And so with that, I think we have a good deal of information that can guide us towards making a decision on our FOAK pyrolysis investment. And so in our finance section, we are going to discuss what all this means for decision making. Now, at this point in time, we're no longer just looking at the numbers. We also need to look at how the expected IRR and risk aligns with our organization's risk appetite. For a large, well-established company with strong and stable profitability, the natural approaches are often more conservative. There's less pressure to take on high-risk investments and greater emphasis on protecting existing value. So, from that perspective, plastic pyrolysis is hardly an attractive option. On the other hand, if you're a company that is under pressure to evolve, or if you're operating more like a venture investor, the assessment can look quite different. You may be more willing to take on greater risk in pursuit of a transformational opportunity or a big payoff. But in that case, the investment is effectively a big bet that strong recycled content mandates will be implemented and strictly enforced. We're also going to bet that the best balancing rules will remain favorable because without these two conditions, you're unlikely to achieve any level of return that would justify the investment. But should you still choose to invest, we can also draw some deeper insights from analysis to help us identify the winners and how we can best protect our investments. Notably for plastic pyrolysis, we learned that the real priority here is not in feedstock cost, but its physical availability. Because in order for any of these projections to hold, the plant needs to operate at full capacity. And if we think about it in another way, it also means that a slight increase in feedstock costs will not have a huge impact on our returns. So it actually makes sense for the investor to put some money towards securing enough high-quality feedstock, even if it comes at a slight premium to support plant operations. Secondly, field-exempt mass balancing will hinder the business case for plastic pyrolysis. And this finding can actually inform our commercial strategy. We can prioritize selling pyrolysis oil in markets that allow free allocation mass balancing, like the US or the APAC region instead of in Europe. Or if we are a refiner, then maybe we can also optimize the way that we allocate the recycled content for each end market depending on the local mass balancing rules. And lastly, the biggest lever for plastic pyrolysis, as the analysis has shown, is product price. And just as importantly, there's also a lot more flexibility here. It is far more realistic to expect a 2 or even 3 times premium on recycled products, particularly when they're driven by policy, than it is to achieve an equivalent reduction in technology costs. So if you're evaluating different pyrolysis investment opportunities, the focus should be on technologies that can deliver high value, high quality outputs, rather than innovations that simply minimize costs. And this can also mean that we should be taking action to maximize product value, like lobbying for more supportive policy, targeting the right application markets, or even locking in long-term contracts at favorable product prices. And the best part of this framework is that it also applies to other emerging technologies and first-of-a-kind projects. Whether it is something as early stage as a CO2 to PHA technology, where the technology itself and its scalability is still not well established. Or something a bit closer to commercialization, like natural fiber composites, where the main uncertainties lie in the market demand for the emerging material. So I want to invite everyone who's on the line today, who's looking at investing in a first-of-a-kind plant to apply this methodology. Consider the current innovation maturity and project what conditions will look like in the future. Then ask yourselves, will investments still make sense 5, 10, 15 years down the road? And with that, I'll start wrapping up with some key takeaways here. Firstly, we have to look at innovation maturity holistically. Technical readiness is just one aspect of it, and successful commercialization requires the rest of the ecosystem to be ready as well. Secondly, we must consider the uncertainty when making investment decisions. That is because circumstances can and will change across our plant's lifetime. And finally, we should apply scenario planning for longer term outlooks. Considering a range of plausible situations can help us identify good investment opportunities early and help us defend against potentially adverse developments to protect our investments. And I also want to leave you with a few things that you can do today. If you're deciding on your next investment opportunity, use the Lux 5 factors of innovation success to get a quick take on the maturity of the ecosystem. Many of us already filter tech opportunities with TRLs, and we're just expanding that assessment to take a more holistic view of maturity. Next, if you have already made a decision to invest, it's good to check that the investment actually fits your risk profile, and if need be, adjust your expectation of the investment performance accordingly. Then, assuming that we have some challenges with the investment risk, now is the time to protect your investment by addressing any weaknesses you have identified in innovation maturity. Then, it is important to remember that the investment outcome is not static. Even with scenario planning, we are also making a big bet that certain scenario plays out. So you should continuously assess the case for the technology investment as broad market developments start to take shape. What is worth investing in today may just be a game changer in a short 5 years down the road. And with that, if you ever need a hand with taking this next step forward, speak to us. After all, that's the value of your Lux partnership. We're here to help you make better decisions. Thank you.
Thank you, Martian. We will now be taking questions that you have on the presentation, which you can type into the questions box on your screen. Once again, if we do not get to your question on this call, someone from Lux will be in touch after the webinar. Now, I see quite a few questions and some very similar, so I will kind of consolidate some of them. And I think one really obvious one is, from the analysis that you've shown, it does not seem like plastic pyrolysis has a great outlook. But do you see any way for a good business case for plastic pyrolysis? You know, real world examples where success has been possible. What was the factors behind that?
Yeah, I think the best case study for success is really what ExxonMobil has been doing. And if you consider what we did for our analysis, we looked at plastic pyrolysis as a standalone operation, right? We are producing pyrolysis oil and we're making margins on that pyrolysis oil itself. But if we follow Exxon's model, where we are actually vertically integrated across the entire value chain, all the way from feedstock collection, feedstock processing, pyrolysis, and then downstream with pyrolysis oil refining and ultimately the production of the recycled plastics itself. There are margins to be made across different levels of the value chain. And if we are vertically integrated, it actually gives us some greater flexibility on where these margins can be made. So all in all, if we look at just plastic pyrolysis on its own, probably not such a great investment case, but if you take into account the entire value chain, right, and we are making premiums on the recycled plastic itself, I think there is a big chance that it can also make sense from a ROI point of view.
Excellent. And as a follow-up question here, obviously for the presentation, we focused on plastic pyrolysis. Certainly there's many other different types of advanced plastic recycling technologies. Did you see similar results for those other technologies? For example, depolymerization, cellulose, etc. Were there any really notable differences between the technologies themselves?
Yeah, I think there are huge differences because we did a very similar analysis for textile to textile PET recycling. We did a similar analysis for waste to aromatics or waste to monomers recycling. And we saw that in most cases, the technologies actually have a positive IRR that could go up to the high tens of percent in the expected IRR. I think largely this is because the product, the ultimate product that we're getting a premium on is actually the actual recycled plastic itself, right? And again, this leads back to the first question on the weakness of pyrolysis as a standalone operation. We're making premiums on just a intermediate feedstock material when the real money to be made is actually in the final plastic itself. And so the investment case actually looked much better for the other technologies compared with plastic pyrolysis.
Okay, interesting. I think we have time for one more here, and it's one I actually like here that was asked. So obviously the methodology is really interesting, right? You have all the simulations, you look at sort of average IRR, average level of risk, but one factor is kind of missing is timing. You know, what's the best approach, or what's your recommendation to take into consider timing when looking at this business case today versus say 3 months, 6 months, 2 years from now?
Yeah, I think the most obvious milestone that we can look for, the most obvious deadlines that we can look for to reassess the investment case is actually the regulatory deadlines. As we have seen with the analysis, and not just for pyrolysis, but with everything else, right? The recycled content mandates have a huge impact on the IRR, the expected IRR of the projects. So looking at how regulations change and how they impact demand for recycled plastics can actually be a good marker and a good reminder for you to reassess the investment case in terms of timing.
Okay, then. Well, thank you, Martian, again for your presentation. For all our attendees, that concludes our webinar for today. The slide presentation and the recording from this webinar will be sent to all of you. After leaving the webinar, you will be prompted to complete a survey on today's presentation. And of course, we greatly appreciate any feedback you have to help inform and improve our future webinars. And in the meantime, please take a moment and check out our upcoming webinars on our website. And thank you all for joining us, and have a great day.
Thank you.